new NBR working paper on Fed independence. Um, so this paper is an attempt to estimate the effect that Trump, and specifically his tweets about the Federal Reserve, has had on Fed independence. Whether his I don't know if threats is the best term, but his tweeting about the Federal Reserve and his critiques of them, whether it's actually influencing Fed policy. So they found that the expected federal funds rate, so what market participants believe the federal funds rate will be, is impacted statistically significantly by his tweets. So they measure literally what's going on in the federal funds future market immediately before and after each tweet, what we normally call an event study. So while it may not show that the Federal Reserve is actively responding to Trump's tweets, it shows that the market participants believe they're going to respond to tweets. It says here around 10 basis points. And normally when you look at measures that involve people spending their own money, they tend to be fairly accurate because they're going to be willing to put their money on a bet like this. They're going to have their homework done. They're going to really believe it. It's different than just a pundit, going on to CNBC and talking about it. Additionally, we talked about forward guidance, how that's been a central part of the Federal Reserve's monetary policy since the financial crisis. It turns out that Jay Powell, in his most recent press conference, declared forward guidance virtually dead. That the Fed won't be using that as much going forward. It was very useful in the aftermath of the recession when inflation expectations were super low. People just didn't believe there was going to be inflation for a long time. So they had to say, we're going to keep interest rates low for a long time, maybe even longer than we should, in order to help people get their inflation expectations up. And they started publishing the dot plot that I showed you before of the Fed's expectations for the federal funds rate policy in the future. And that was done, again, just to highlight how strongly they were committed to low interest rates for a long time. Once they began tightening, their message was we'll raise rates very gradually. When they first began tapering the purchases from QE3, so not even tightening monetary policy, just becoming less loose, the markets reacted very poorly. There was a huge stock market sell-off like that day. So then they wanted to communicate clearly what the taper was going to be, and then once they finished those purchases and began raising rates, they wanted again to say it's going to be very gradual. They're not going to shock the market with anything. But now that the Federal Reserve has started easing rates, the last two policy moves have been to decrease the federal funds rate. The strategy of forward guidance has become more of a liability for the Fed because now they could go in either direction. If downside risks end up being stronger over the next 6 months than the Fed believes, like right now, if they communicate that they plan on keeping rates the same, but it turns out because of things that were unforeseen by the Fed that they're going to need to lower the interest rates, they don't want to be tied to their previous announcements.
I think the next time they meet them, they'll have like markets will kind of be jolted, because I feel like from what I've read up on it, whenever they give guidance, it's actually anticipated, so it's priced in. But then when they don't know what's going to happen, and they do something that's opposite of what they expect.
I think that's a pretty good guess for what's going to happen next, but it does depend on how clear the economic indicators are. So if it's clear that the economy's its performance is worsening, then the market should be able to price in that the Fed's going to use rates one more time. But if things are more murky, say we still have trouble, like threats of tariffs with China. We don't know what's going to happen there. Say Europe or emerging markets, either of those are down. Consumption is slightly up, consumer confidence slightly up, unemployment stable, and inflation stable. Depending on what the Fed wants to focus on, they could go any way for that. So you could see a huge jump as like an immediate reaction once the Fed announces what they're going to do. Policy was pretty easy, I say matching the market's expectations is pretty easy during the recovery because people kind of knew what was going to happen. Once you reach the next peak, it's much more difficult for the market to accurately expect what's going to happen. There's just more things that can happen. Those are just some things I wanted to point out, especially the forward guidance being a less prominent part of the Fed's policy going forward. Next, we're going to look at the money supply process. This is the banking part of money and banking. The money supply is obviously important. It impacts inflation and the interest rates. Our Friedman said that inflation is always everywhere a monetary phenomenon. So we're going to do this chapter is examine the money supply process, how the Federal Reserve and banks create money. Bank deposits are the largest component of the money supply. And the Federal Reserve has, through monetary policy, has like the strongest effect on the money supply. So the three main players, obviously, are the central bank. So in the United States, it's the Federal Reserve. And for our course and what we're trying to study here, that's going to be the most important part. Next is banks. So this is any sort of depository institution. So includes typical commercial banks, credit unions, savings and loans, any of those. And finally, depositors. These are going to be the individuals or institutions that have deposits at other financial institutions. And we'll see how each of their actions affect what goes on with the money supply. So to start out, here's a very simple version of the Fed's balance sheet. Obviously, their balance sheet is much more complicated than this. So on the liability side, we have the currency in circulation. So literally the pieces of paper you have in your pocket. That's all the currency. So the currency that businesses have at the end of the day, all that kind of stuff. The only currency that doesn't count is the currency that banks hold in their vaults. Those are part of reserves. The reserves are obviously the cash in the vaults that they have to give out to individuals that are withdrawing, and it includes the reserves that they're required to hold with the Federal Reserve to make sure that they have adequate cash on hand to be able to cover their liabilities. Reserves are liability for the Fed because they have to pay those banks, literally give them the money anytime the banks come to them to withdraw their reserves, and it's an asset for the banks because they can get it in payment. The assets for the Fed are securities. Typically, these are government securities, so short-term treasuries, but they can also be the longer-term treasuries like we saw in the maturity extension program, Operation Twist. And from QE1 and QE3, they had private assets. So a lot of mortgage-backed securities from Freddie and Fannie, but other toxic assets that they got from banks during the height of the financial crisis, when they were trying to make sure banks were solvent enough for one bank to want to be able to buy another bank. Another asset is loans to financial institutions. These are primarily discount loans. Banks can go to the Federal Reserve to borrow overnight in order to make sure that they have adequate funds on hand to meet the reserve requirements. So if the Fed says you have to hold 10% of your assets in reserves, at the end of the day, the bank only has 9% of their assets in reserves. What they do is they go and they borrow money For discount loans, they go to the Federal Reserve and they borrow money from them to have enough to meet that requirement. And then the next morning, once trading opens, they repay that to the Federal Reserve with a slight interest rate. So the Fed earns money on their discount loans. Now, discount loans are very rarely used. Normally, banks borrow from other banks in the federal funds market. So the interest rate on that is usually slightly higher. But so instead of going and borrowing from the Fed for overnight, they go and they borrow from another bank for to make sure they have enough funds overnight. And that's primarily been the Fed's main interest tool or main monetary policy tool is trying to affect the interest rates for overnight loans from one bank to another. Discount loans tend to only be used when banks can't get a loan from another bank, whether it's because of financial instability, that banks are really cautious about lending, or if it's because the bank itself is illiquid, and other banks believe that they might be not solvent. The discount window has really gotten a stigma, so banks try to avoid using that at all costs and try to get their loans from other banks. The Continental Illinois National Bank and Trust, back in the 1980s, they couldn't get a loan from anywhere else, so they used the discount window. And after that, the market believed that meant they were insolvent, so no one would loan to them afterwards. So since then, it's had such a stigma that, except during like severe crises, banks try at all costs to avoid the discount window. And even in like the I think the late 90s, the Fed tweaked their discount window rules so that banks had to have actively sought loans from other banks first before they go to the discount window. Early on in the Fed's existence, discount loans were a much more prominent tool that they used, and at one point the Fed was frustrated that so many banks were using that because they weren't trying to get loans elsewhere. So here we have the monetary base. On the left side here, in millions of dollars, we have this blue line, the excess reserves. So you can see up until the financial crisis, there were very few excess reserves because they didn't earn any interest on excess reserves until the financial crisis. There was no reason for banks to keep large amounts of them. Obviously, since then, it's become a Fed policy tool, so you see a lot more of them. The red line is M2, that's the money stock. You see a general upward trend with that over the entire time. Now, if you zoom in here on this little tiny spike right there, one of the few times you see a lot of excess reserves, that was in the aftermath of September 11th. The Federal Reserve expanded the money supply. If you zoom in more on that date, it looks a lot bigger than it does on this thing. But they provided a lot of liquidity. I think the New York Stock Exchange was closed for a week, so there was a lot of concerns, obviously, about the attack. So the Federal Reserve wanted to make sure that banks would have enough money on hand to be willing to lend to help get through that period. And you see the drop down like immediately afterwards. So, so the Fed, I mentioned the Fed isn't funded by Congress through the appropriations process. They're funded based on their own profits. The return they earn off of securities and off of their discount loans are pretty substantial. The balance sheet has expanded substantially since the crisis, and they even made a profit off of the financial crisis. The liabilities, reserves, the required reserves don't pay anything, don't pay any interest. The excess reserves do pay an interest rate now, and the currency in circulation obviously doesn't pay any interest. So they end up earning a lot more on their securities and loans than they do on their liabilities, which is how the Fed, how it funds itself. Most of the money it earns, it just gives to the Treasury, but they keep enough of it to, fund the Fed itself, keep those nice buildings up. So another term for the monetary base is high-powered money. That they mean the same thing. So the monetary base is the sum of the currency in circulation and the total reserves in the banking system. That's just what's going to make up the money supply. The Fed uses open market operations to influence the money supply. So what they do is if they want to increase the money supply, they buy bonds from financial institutions. By giving the financial institutions money for a bond, obviously that expands their balance sheet. That gives the banks money, which in theory they will loan out. That's how they put downward pressure on interest rates. When these banks have more money on hand, they're going to be more willing to lend in the open market overnight to make sure that to help other banks meet their reserve requirements. It's also going to make them more likely to lend to consumers or to businesses that need a loan, again, because they have more money on hand. Open market operations, if they want to decrease monetary base, so they're going to do the opposite. So, they're 5 months, so they're going to sell bonds. So they sell an asset to the bank and they get money back from the bank, taking money from the banks, so they'll have less money to loan. Because of that, they're going to need higher interest rate if they're going to lend overnight to other banks. So that's going to put upward pressure on the federal funds rate, and that's basically how they conduct monetary policy. Again, it's the Federal Reserve Bank of New York that's actually engaging in these open market operations. So they're the ones buying and selling. The FOMC, once they reach their decision of what their goal is, they tell the trading desk of the New York Fed to do it, to reach this number, so then they sell or buy the appropriate number of bonds to do that. There can be substantial fluctuations during the day in some of these short-term interest rates, but over the longer term, what we see is that meeting the Fed's target rate. And another note, the primary dealers, these are the financial institutions that the government, or I guess that the Fed sells or buys the bonds from. So it's a subset of banks in the financial industry. So then they're not selling to all banks, it's just a certain number of them. And from there, they make loans or they buy or sell bonds. And that's how the interest rate spreads throughout the banking system. Some economists have called to make it less restrictive, to allow more banks to do it, or even other firms like insurance companies to be able to use or be involved in open market operations, rather than just the primary dealer system. But currently, that's how it works. It's just a small number of financial institutions. All right. So let's walk through how open market purchase, how it works. So in this case, the Fed is purchasing $100 million worth of bonds from a financial institution. Right. Yeah. So the primary dealer is going to sell $100 million worth of bonds to the Federal Reserve. So the number of securities they have, or I guess the value of securities they have, is going to decrease here by 100 million. And then they get money from the Federal Reserve. So the reserves are going to go up by 100 million. I wasn't great at accounting, but these two numbers are going to have to match each other. So this is for the banking system in general and for that primary dealer specifically. For the Fed, um, so the securities are going to increase by 100 million, and reserves are going to increase by 100 million. They've just bought more securities, and this bank has now $100 million more worth of reserves. So what ends up happening is that the reserves have increased by $100 for, well, for the banking system in general, but for that primary dealer as well. But there's no change in the currency at this point. At this point, the bank has left that $100 million in their reserves. The monetary base has risen by $100 though. Now in this situation, I would show you that slide earlier with the excess reserves in the system since the financial crisis. This happened a lot since 2008. That banks get these loans, get the money in the primary bend through quantitative easing, 1 and 3. And they kept a lot of that money as excess reserves. So while the monetary base has increased, what we haven't seen is that currency actually increasing, so money going out into the economy because banks are holding on to it. So here we have an open market purchase from a non-public bank. I don't remember what their Yeah, they didn't even talk about this. Okay. So, the reserves are going to go up by 100 million. Again, because they've gotten that the Fed's purchased $100 million worth of bonds from them. In this case, their checkable deposits is also going to go up by 100 million. For the Fed, their securities are going to go up by 100 million, again, because the purchase is $100 million worth of assets, and their reserves are going to increase by 100 million. So a person that's going to sell the bonds to the Federal Reserve is going to deposit the check, the Fed's check in the bank. That's where it's going to go. So it's an identical result as a purchase from a bank. This wasn't in the chapter at all, so I don't know why they put this in the PowerPoint slides. So, all right, let's just summarize open market purchases. The effect of an open market purchase on revenues depends on whether the seller keeps the proceeds in currency or deposits. If it's kept in currency, you're going to see a different change in the money supply than you are if it's deposited in other banks. It's always going to increase the monetary base, but we're going to see different effects on the broader economy based off of whether it's held in cash or whether it's going to be deposited in another bank. And we should be walking through that soon. Here we have an open market sale, which is just the opposite. So in this case, a bank's going to get securities and they're going to pay money to the Federal Reserve for it. So for the Fed, their liabilities go down because there's less currency in circulation, but they're also going to lose securities. The bank's going to gain securities, and they're going to lose the currency that they had to pay for it. So the monetary base is reduced by the amount of the sale. The reserves, see there's been no change in reserves here. So the effect of the open market operations on the monetary base is more certain than than the effect that it has on reserves. Okay. So shifts from deposits into currency. So if the bank turns those checkable deposits into currencies, obviously they're going to have fewer checkable deposits on hand. Now the currency goes up by the same amount. And this is assuming they take all the checkable deposits and put them in currencies. Banking system ends up with fewer reserves because that money is taken out of reserves and it's converted into currency. So in this case, the net effect of monetary liabilities is zero. The reserves are changed only by random fluctuations. It's not going to be changed. It's not guaranteed based on the purchases. So the monetary base is relatively stable. Unlike, say, like the interest rates I mentioned have a lot of short-term fluctuations. Okay, this is multiple deposit creation. This is what's called the money multiplier effect. So when the Federal Reserve makes these purchases, they put more money. They buy securities from the bank, put more money into the economy. It doesn't just increase the monetary base by that much if banks keep them as deposits instead of switching to currency and just holding cash. Obviously, when most people take out a loan, they're going to not just hold that loan as cash. They're going to end up spending something with it. So they're going to send that money to another bank for whatever their purchase is. So when I got a loan for my new car a couple weeks ago, I didn't just hold. When I took out a loan, I didn't just hold it in cash. Send it to another financial institution. So let's go with the same $100 million purchase that we had in the example before. So in this example, First National Bank, which is the private bank, they give up $1 million securities to the Fed, and they get $100 million worth of reserves. What they end up doing with that is loaning it out. So now, let's say they loan out the entire thing. So now their reserves and loans both increase by the same amount of money. However, they can't do that for very long. They have to take the reserves out. So in this case, their excess reserves increases, and then they loan out the excess reserves. Basically they create a checking account for the individual that gets the loan to deposit into, to pay to, whoever they're buying the good that they need a loan for from. When the borrower makes a purchase, the money supply is increased. So they're actually, spending that money into the money supply. So now this goes to Bank A. So the next bank, their checkable deposits go up. So that checking account I mentioned on the previous slide, that's now checkable deposits for Bank A. So they're going to turn, let's say they have a 10% reserve requirement ratio, just to keep the math easy. In this case, they're going to end up, they don't want to just hold reserves. What they're going to do is they're going to loan out the money. So they're going to loan out $90 worth and keep that 10%, the $10 million, in their reserves. They're going to loan that, let's say, to Bank B. They're going to, that money's going to go to an additional bank. So their reserves are going to increase by $90 at first. But again, they're not going to want to just, keep their reserves on hand. So they're going to want to try to make money off it. So they're going to loan it out. And again, they need to keep 10% on hand. So they'll keep $9 million and loan out $81 million. And the process keeps going. Where, yeah, so for Bank C, they end up increasing their deposits by that $81 million loan. They're going to have to keep $8.1 million on hand, but they can loan out the $22.9 million that they now have increased. That can go to Bank D, who then loans out 90% of that E all the way down. So what we're going to see is that for $100 million that was initially added to the money supply by the Fed, we're going to end up with an increase in money supply by $1 billion. So even though the Fed initially only increased the money supply by 100 million, we have an even greater increase in the money supply because of the way the banks are loaning out the money. This is due to our banking system being what's called a fractional reserve banking system. So because they only have to keep a fraction of their assets on hand, they're able to loan out more money. There's a few, I hesitate to call them economists, but a few people who are against the fractional reserve banking system. So they think banks should hold all that money on hand that they get from the assets. In that case, you would not see a greater expansion of the money supply. From a $100 million purchase, you would end up with an increase in the money supply by $100 million.
That'd be like the only way to increase the money supply, just the Fed giving out money.
Yeah, that would be it.
Interesting. Like there'd be no inflation, pretty much.
Yeah, more or less.
It'd
There's
also
other
be-
ways to achieve zero inflation than that, though.
It'd also be like really hard to earn interest
Yeah.
or repay interest.
Yeah, it makes a lot of things in our banking system impossible. Basically, a bank would be like a security deposit box. So you would have to pay them you would have to pay them to like hold on to your stuff for you because they couldn't make money loaning it out. It's safer, it's less prone to runs like banking panics because banks have all that money on hand. So there's no need to be worried about them not having your money when you went to go get it, but it completely changes the nature of the banking system. So there's a simple formula for multiple deposit creation. So, the process by these banks loaning out those reserves that are initially spent. Basically, all it is, is the reciprocal of the reserve requirement. So in our example, we had a 10% reserve requirement. So we're going to have a 10 times deposit multiplier, which, looking at the slide, that billion is 10 times 100 million. Using round numbers keeps it simple. The actual formula, if it was a more typical number, is the change in the total deposits in the banking system equals the inverse of the reserve requirement ratio. So 1 divided by the reserve requirement ratio times the change in the reserves in the banking system. And this delta R should be capital R. So in this case, you would just plug in the 10% for the reserve requirement, for lowercase rr, and plug in 100 million for the delta r. And that's how you would get the 10 times. There's some shortcomings to the simple model that I described. People holding cash stops the process. There's no multiple deposit expansion, anything like that for currency. You only see that for reserves held by banks being turned into loans. Also, banks might not use all their excess reserves to buy securities or to make loans, like we've seen since the financial crisis. Especially now that the Fed pays interest on excess reserves, banks now have an incentive to keep money in excess reserves because it's so safe. Depositors' decisions on how much currency to hold and banks' decisions on how much excess reserves to hold can also cause the money supply to change. In the lead up to the financial crisis, a lot of people would, say, refinance their home, or if they were purchasing a home for the first time, take out extra money and then use that to make purchases. It's easy to see people keeping some of that cash on hand in order to spend over the next couple months instead of just spending it initially. So all these make the multiple deposit expansion go at a slower pace. I don't know if this includes an example. No, so say First National only increases their loans by 90 million, and they keep 10 million on hand, just as excess reserves. What's going to happen is you're not going to get the same 10 times expansion of the money supply. You're going to get, it's going to be, I don't know, I won't do the math off the top of my head, but it's going to be smaller. Yeah, so I think, unless you guys have any questions, we can end here for the day. It's a little early, but I forgot to bring my textbook home last night, so I didn't get a chance to read over everything again before class this morning. So I'm not going to try to bullshit through the money supply process anymore. All right, sounds good.